Hi friends, my name is Rahul Jain. I'm a SEBI registered research analyst. In today's video, I'm going to speak about evergreen stocks. What are evergreen stocks? So evergreen stocks are those companies that have been consistently compounding and are likely to continue to compound in the future as well. Now, when I say compounding, I do not necessarily mean the stock price. What I mean is top line growth rate, revenue growth rate, maybe more than 15%, PAT, profit after tax, growing at 15% or more. EPS, earnings per share, more than 15% of growth rate seen in the past and likelihood in the future as well. ROE, ROCE, more than 15 to 20%, right? And also you have to look at the quality of the company subjectively by looking at their business mode and whether they are continuously innovating or not, whether the sector has the tailwinds or not. Some of these aspects also need to be considered while doing analysis. It's not just putting these filters out and you find the companies. Okay. So in this video, I'm going to speak about 3 such companies. There are more than 30 companies that you can easily identify. If you want me to create a series of these videos so that in every video I can cover, let's say 3 to 4 stocks, then let me know in the comments. If I get more than 1000 comments in this video, meaning 1000 people asking me to create series of such videos, then I'd be happy to do this. I'll create 10 videos and you'll get those 30 companies. And the intent of sharing these 30 companies with you will be that you can start constructing your portfolio around these 30 companies whenever, let's say, the market is down. Whenever there is a huge correction, whenever there is a temporary setback in the company itself, meaning that the valuations have come down drastically. And lastly, if you do SIPs in stocks, it also offers you that opportunity as well. With that intent, if you let me know in the comments if you would like a series, then I definitely would come back and create that series if I get more than 1000 people. 1000 comments for me is good enough. With that, let me get going now and start talking about stock number 1. Before that, please hit the subscribe button. It's important that you subscribe to this channel so that you get timely information. With that, stock number 1 is Bajaj Finance Limited. Now I'll speak about Bajaj Finance's business mode, their valuation, their past track record, their AI journey, a lot of information. Please be patient. Listen to this commentary for the next 4 to 5 minutes. First quick point, if you look at their 19 years financial snapshot, couple of things important that you need to know. One is that growth rate. If you look at the CAGR basis, okay, what you note, for example, loans, 25% CAGR basis growth rate. Customer franchise, which is in millions here, so 32% CAGR growth rate in the customer base. Okay. If you look at asset under management, 34% CAGR growth rate. If you look at net total income, around 33% of CAGR growth rate. If you look at profit after tax, around 46% of PAT growth rate in the last 19 years or so. And that has compounded beautifully for the company. If you look at return on assets, one of the important parameters for banking and NBFC companies, look at this, it stands at around 4.3%. Very, very high. Compare this with HDFC Bank, ICICI, it's around 2%, not more than 2%, right? Look at return on equity. It's around 18.1%, albeit it has come down. It used to be around 23% back in FY23, come down to around 18%. All right. Look at their net NPAs, the quality, the asset quality. It's around 0.41%. The finest quality that you will get in an NBFC is Bajaj Finance. Now, having said that, whenever you're looking at companies and their past track record, always look out for the last 3 to 4 years as well. What is the last 3 years trend as well? That is also very, very important. So what I did was I did some calculation, and what I found is that if you look at the last 3 years data, all these metrics that I just talked about, the numbers have come down. Meaning, for example, loans growth rate used to be 25% if you look at the 19-year period. But if you look at the last 3 years, it's come down to 21%. Likewise, if you look at PAT, for example, it used to be 46% if you look at the last 19 years, but it's come down to 20%. What is it telling you? It is telling you that possibly the profit growth rate has been slowing down in the last 3 years. Okay. Now, what could be the reason? Very natural reason could be that if you're looking at 19 years long period, when the company started back in, let's say 2008, 2009, at that time, the base was very small. Okay. But as the base grows for a company, the growth rate cannot be sustained at those levels. Okay, please understand that this is a very, very natural phenomena that happens when a company becomes from a small cap to mid cap to large cap company. Okay, hope that concept is very, very clear. The other positive side you can take out of is that the company is still compounding at around 20% PAT, even though they are sitting at 19,000 crores sort of a PAT. So the scale is very high and still it is compounding at 20%. So just imagine how much of PAT it is adding almost every single year into their P&L. That's how you need to read it. Okay. Now this is all past history. What about the future guidance? Can it continue to create this sort of results in the next 10 years, 20 years. Here is the long-term guidance that the company is giving. Okay, AUM growth rate 23 to 25% range. Profit growth rate 23 to 24%. Gross NPAs less than 1.4%. Net NPAs less than 0.5%. Okay. Return on assets around 4.3 to 4.7%, which is almost double of the banks of likes of HDFC, ICICI, SBI, etc. Okay. Return on equity almost 19 to 21%. So the management seems confident. That is the long-term guidance they have given. It doesn't need to follow quarter by quarter. It doesn't need to follow every single year. If you see that the company is not doing well for, let's say, 3-4 quarters, 8 quarters also, then understand that the company is going through some sort of a bad patch, some sort of bad sectoral headwinds that might have come into the, let's say, finance world or NBFC world, right? Those are the times when the stock will get hammered down. And those are the opportunities for you as a long-term investor. If you're thinking long-term, if you're thinking to do SIPs on stocks, sit on it for the next 10 to 12, 20 years, right? These are not 1 to 2 years sort of a bet. Okay. Now coming to the couple of points around business mode of this company, and then I'll come to the AI part of the company. The biggest business mode the company holds as of now is their customer franchise. If you look at this, 119 million customers, meaning around 11 crores. And if you look at that, out of 11 crores, around 63% of them, around 7.5 crore customers, they can cross-sell. So there are a lot of products that Bajaj Finance sells, right? Mortgage, personal loan, this loan, that loan, right? They can cross-sell it. Okay, that is one of the biggest business mode. Companies like Jio Finance, for example, their competitor, they are trying to build exactly this. They are in the process of building their customer base. Okay, while Bajaj Finance has done it. They have done it for the last 20 years. They are now sitting at around 11 crores of customer franchise. But guess what? They still only have 2.5% of market share. I'll talk about that. I'll show you that number in a minute. So the growth potential is still huge in India. Okay, everybody needs loan in India. Okay. Now coming to their distribution reach, which is the second business mode here. If you look at interesting data points here, I'll not bore you with a lot of details, but one important red flag here that you might note is that the net addition into their distribution network has been reducing. So for example, 2024, 43,000 was the net addition in the distribution network. Okay, but it has come down to 6,000, 2,750. In fact, in 2025, it was even low, 850 in the quarter, and in 2026 quarter, only 1,600. So one could argue that this is a red flag. But when I was reading their last year's annual report, what I found is that they have done a partnership with Airtel. Okay, and in that partnership, they are also going to leverage Airtel's distribution network of around 1.2 million. And mind you, Airtel also has a customer base of 375 million, 37 crores of customers. This partnership is a good strategic long-term partnership in my view. So I'm not worried about the distribution network not being there in terms of physical. They're doing some partnerships. They're still continuing to leverage others' distribution network if they need to, right? Now coming to the AI part. Okay, so again, if you go and read about their AI journey now, they are calling themselves, in fact, Bajaj Finance Limited 3.0. And their 3.0 is solely relying on a Fin AI company. They used to call themselves earlier FinTech company. Now they're calling it Fin AI company. And you will see this narrative coming up with a lot of other companies as well. Everybody will start calling themselves a Fin AI company. No longer tech is a good word. AI is a good word right now. But are they able to walk the talk? For example, they're saying that we are going to have next 100 million customers using this strategy. Okay. Now, what are they actually doing for this? AI for revenues, AI for cost reduction, AI for design and engagement, AI for risk, AI for credit, AI for productivity. Everywhere they are going to put AI. Are they actually doing it? Let me show you their Q3 FY26 con call commentary, where the management said that they have processed around 20 million calls using AI, converted customer calls into text and then text to data conversion. 5.2 lakh customers, they have generated around 100,000 new loan offers using that AI capability. Okay, again, you can read a lot of details here. I'm not going to go into details of that, but point is very, very simple. Company is now pivoting, or rather transforming themselves into an AI company, and they're going to use AI a lot. In fact, I was reading about their management commentary, and what they're saying is that in the next 6 to 18 months, they're going to launch around 800 plus autonomous agents across ops, HR, IT, risk, DMS, etc. The company says that they are also going to come up with a consumer AI platform by June 2027. Still 12 months out from when I'm creating this video, but this is where consumers can switch on the AI mode and do a lot of things. Okay, so a lot is going to happen in this company in the next 2 to 3 years when it comes to AI. I was reading their recent con call for Q4 FY26. Again, you can read a lot of details here about their details on AI, a lot of things are happening here. Macro message for you is that the company is pivoting into Fin AI company. Okay. Now here is the screenshot that earlier I was talking about, that they only have around 2.5% of the market share. Okay. This is what Rahul Jain is saying. They can continue to grow faster than the industry. Industry credit is growing at around 12%. They are growing at 22%. So they are almost growing twice as the industry. That's why they are one of the finest NBFCs that India has produced so far. Now, very quickly, if I talk about their valuation. So if I go and talk about their valuations here, if you look at the price to book ratio of Bajaj Finance, you will note last 10 years, median has been 8.1. Okay. Highest it has traded at around 13 price to book. Now it is trading between 4 to 5. The valuations have calmed down. I don't think the story has calmed down. This is just my reading. Very, very good company in my view. Again, not saying that you go and buy this company here, but hope you get the point in terms of why this could be one of the evergreen company. There might be some short-term challenges here and there, 1 quarter, 2 quarter, 3 quarter, but maybe those are the opportunities. Look at the valuations always. Consult your financial advisor. This is not a recommendation, but I hope you got a lot of insights about Bajaj Finance. That was stock number 1. With that, let's move to stock number 2 now. The second company that I want to speak about is from auto sector, company called TVS Motors. Before I give you the insights about TVS Motors, let me actually quickly give you what is happening in automobile sector of India. Okay, have a look at my screen, and what you will note is that we are selling more two-wheelers, we are selling more cars, we are selling everything more and more in auto. Okay, for example, back in 2017, if we look at the total contribution, so if we were selling 100 vehicles, out of 100, how many two-wheelers were we selling? 79. Okay, majority of them are two-wheelers. But if you come to now 2026, we are selling less as a contribution. We are selling only 74 motorcycles. Okay, why? Because a lot of people who used to drive the motorcycles now are able to afford cars, because in India, people's disposable income is growing, right? That's why. But still, the number of motorcycles, if you see the blue line that you see in the top, it is still growing. Why? Because people who were not able to afford motorcycles earlier, back in 2017, they are now upgrading to from, let's say, bicycle to motorcycle. We are continuously selling more and more motorcycle, and I don't think it is coming down. It will continue to go up. Second important insight that you need to know is even more important, which is the EV sales within the automobile sales. So what you note here is that, for example, let's go back to 2017 here. If you were selling 100 vehicles, almost 0.39 was the electric. Okay. Now look at 2026. We are standing at around 10. Out of 100, 10 vehicles are sold electric. Okay. Huge growth. Now, why this is happening? Couple of reasons for that. One of them is mainly the policies that the government is making. For example, just a couple of months back, Delhi released their EV policy. Okay. Now, I'm not going to go into a lot of details, but you just need to understand a couple of major points. In Delhi, for example, from 1st April 2028, which is 2 years away from now, motorcycles cannot be registered if they are petrol or whatever, right? Only EV motorcycles will be registered. Okay. Can you imagine, after 2 years, you will not be able to buy a new petrol, motorcycle or scooter for that matter, right? That is what is happening. Also, there are a lot of subsidies that government is giving, 10,000 rupees per kilowatt, 6,600 per kilowatt, because electric vehicles are costlier as of now because of the battery cost. Government is giving all of these subsidies. Third point, if you look at the GST reforms, okay, on two-wheelers, it came down from 28% to 18%. And guess what? EVs, we only have 5% GST. Why? Because the overall cost is very high. So government is doing a lot of things to bring the cost down for EVs. And this is just Delhi. I'm pretty sure that a lot of other states will start rolling out something very similar. In the next 5 years, all you will see in India, potentially 90%, 80% is the EV vehicles. Okay. So this is a very, very good long-term growth sector in my view, have all the right tailwinds as of now. Now, if you look at the market share in two-wheelers EV, you will note that this is a February 2026 data. And this has been very, very consistent. For example, TVS is at number 1, TVS Motors, number 2, Bajaj, Ather, Hero MotoCorp, etc. Okay, TVS is leading by margin. Okay, second is Bajaj and third is Ather. Okay, now Hero MotoCorp also has major stakes in Ather, and they also have their own vide. So point is that none of these companies are bad, first of all. Okay, all of these companies are going to enjoy these sales that are likely to happen. Okay, they all will be the winners in my view. But if I talk about one of the fastest growing company in this, that is TVS, clearly by market share. Can they protect their market share? I think likely, but again, I cannot really predict future. But looking at a lot of things about TVS as a company, I was reading their annual report as well. The kind of R&D they are doing, the kind of products they are launching into, let's say, scooter segment, 125 more than 125 cc segment, that is just phenomenal. Okay, and they are doing a good export as well. So Bajaj and TVS, they do a lot of export. Around 25 to 30% of their sales come from global export. So as compared to Hero MotoCorp, which is around 5% only, if I'm not wrong. Anyways, the point is very, very simple, that these companies are likely to grow as the sector grows. But out of these, if I talk about TVS, let me give you a couple of minutes commentary on TVS now. Now, if you look at TVS Motors last 3 years of financial performance, there are few insights that we need to understand. Number one, if you look at the revenue, which is the sales into price, okay, that has grown at around 11.1% of CAGR. Okay, if you look at the volume, which is grown at around 8.8% CAGR basis, what does this tell you? That the volume has gone up by 8.8% CAGR basis, but the revenue has gone up by around 11.1%. So revenue growth is higher. What does this tell you? It tells you that the company has the pricing power. Even though the volume had gone up by only 8%, the pricing has gone up by around 11%, the cumulative impact of the price into sales. Okay, very, very good sign. If you look at the EBITDA, have margins improved? Yes, 10.1, say 11.1, 12.3. Margin has been continuously improving. If you look at the PAT, for example, CAGR is 22%, okay, and the margins have improved from 5.7 to 6.6 to 7.5. If you look at the earnings per share, CAGR is 22% growth rate. How many companies in India are growing EPS at 22% in the last 3 years? Very few. That's why the company is under the discussion in this particular video. Okay. Now coming to their con call summary, what the management was saying in February 2026, couple of points that you need to understand. One is clearly the GST tailwind is there. It's not just about the EVs. Please understand this. Company is doing pretty well even for the petrol two-wheelers. Okay. And also if you look at the specific commentary, what the management is saying is that scooters are likely to grow faster than the industry. Important point that we need to note. We need to look at those companies where the scooter sales are better. Scooters demand is growing. Okay. Premium and super premium segment is growing faster. Entry level segment is not growing. So anything that is more than 125 cc, that is the premium or sub premium. That is where the growth is right now. This is where the company is operating. If you look at their products like Apache, etc., their scooter Jupiter, all of those products are sort of premium, sub premium category. Okay. Now, if you look at the last 5 years valuations of TVS Motors, PE ratio is very, very high. It trades at around 56 PE. Okay. In fact, if you compare TVS Motors PE ratio versus other companies, they are very, very high. 56. Why? Because they are growing fastest among the peers. The very, very simple reason. Okay. So if growth is your style, then TVS Motor definitely is the number one growing company in the two-wheeler segment. And in the last 5 years, if you look at the top highest PE the company traded at around is 82 before the correction started in September 2024. That was definitely a stressed valuation. It has come down to around, let's say 56 right now, but still slightly higher than the median. Okay. Why? Because of the GST tailwinds we talked about, these EV policies coming out. All of those tailwinds is making this company enjoy the premium, PE premium. If you look at the price to book, you will find very, very similar story, very, very high at the minute. Why? Because everybody wants to have this company because of the reasons that I have sort of described to you. Again, not a recommendation that you go and buy this company at any price. Of course not. Find your entry points, look at the technical analysis. I can't do the price analysis here for you, but look at some technical analysis, wait for some bad news to happen, look at the valuations to come down, and accordingly make your decision. Do not take this as a recommendation, but hopefully this has given you good insights about the company. With that, let's move to company number 3 now. Before we move to company number 3, if you're liking this commentary so far, would request you to share this video with your friends and family. Like the video, let me know in the comments, a simple thank you. Also, you can consider joining my exclusive YouTube community where almost on a daily basis I post insights about the sectors, the market, stocks, not buy sell recommendations, but it will teach you a lot about what is happening in the stock market. Feedback of the community has been good. Simply go to my channel, subscribe to the channel, and then find the join button, be my guest. With that, let's move to company number 3 now. Moving on to third company that I want to speak about is Mahindra and Mahindra. Now, Mahindra and Mahindra is a very, very big company. Okay, there are a lot of companies inside Mahindra and Mahindra group, so it's extremely difficult for me to give you commentary about each of the business. But if you look at the consolidated level, look at the return on equity, okay, and look at from FY21 onwards, how steadily return on equity has improved from 4.4% back in FY21 to almost 20% now in FY26. It's going to easily remain at around 18 to 20% as far as I can see their progress. If I talk about the earnings per share growth rate as well, so see again from FY21 where it used to be around 16.2, it's gone up to around 115.7 in FY25. FY26 number is likely to be published in the next few days. CAGR has been around 63%, massive growth rate, massive pivot from FY21. Last 5 years have been phenomenal. Now, a lot of people think that Mahindra and Mahindra is all about SUVs. While that is true that they are the leaders in SUV segment, I show you the PAT breakdown here. Okay, 25% of their PAT is coming from auto sector, which is including SUVs, which is also including three-wheelers, including trucks and buses, etc. Okay, 39% is coming from farm business, which is your tractors, and 36% is coming from services. So actually, auto business is not the biggest PAT driver in terms of numbers you can see here. Okay, in terms of the cash generated, services business is generating highest cash, which is at 39%, followed by farm business at 32% and auto business at 29%. Now, a couple of changes that have happened recently. One is the GST reforms, and tractors are likely to be the biggest beneficiary. If you go and do some digging around it, you will find that tractors are the biggest beneficiary of the GST revamps, and therefore Mahindra and Mahindra is likely to benefit from that. But again, I'm not going to talk about each and every segment here, because if you look at how many companies that they operate, there are a lot of them. Auto में SUVs, last mile mobility, which is the three-wheelers, trucks, buses, motorcycle, etc. In farm, tractors, etc. In services, then they have a whole lot of businesses here. Okay, be it Mahindra Lifespace to Mahindra Lifestyle to Tech Mahindra to Mahindra Finance, a lot of companies are in there. Okay, now here is one thing that I'll leave you with when it comes to Mahindra and Mahindra, which is around the growth. So FY22 to FY25, their organic growth has been around 25%. Okay, the company says that they are targeting between FY26 and 30, they're targeting an organic growth rate of around 15%. The lowest is the 15%, and higher they're targeting is 40%. Different business segments. Okay. Now, given this growth prospect, if their management is targeting minimum 15% and the upper side is around 40%, I don't know where the numbers will be. You need to look at their valuations. Okay. Whenever you want to invest in any company, look at the growth rate and look at the valuations. Okay. For example, if we go back to Mahindra and Mahindra's valuations here. Okay. So let me go back to Mahindra and Mahindra. Now, if you look at last 5 years of Mahindra and Mahindra's PE ratio, median has been around 26.5. Right now, it has dropped below that median, 24.1. One thing that you need to note down is in the next few days, we will also come to know about how the auto sector is likely to behave in India, because their Q4 numbers that came out recently, they were not brilliant. SUV sales were up only by around 8% if I remember it correctly. That means that there might be some slowdown in auto sector for the next 1 or 2 quarters as a result of the war, as a result of inflation also going up potentially because of the oil prices. So all of these short-term problems may persist for the next 1 to 2 or 3, 4 quarters. But overall, if you ask me, that is the opportunity for you. Okay, because if you're looking long-term growth of, let's say, 20%, 25% in the PAT, if the company is able to achieve that, then the compounding will happen automatically. These bad times, if they come in the next few quarters, there'll be great opportunities in my view. PE ratio right now is 24. Can it come down further? Yes, of course. It has gone down to 18, 17 back in 2023, right? I don't think it will go down to that level. If I am taking a wild guess, I could be totally wrong here. Okay, but yeah, right now it is below median PE. You can continue to track the company. Look at their monthly sales numbers as well that they publish around the auto. Okay, April numbers are not great. Let me be very upfront with you. So there might be some pressure in the next few quarters on the stock price if you're looking at the price. But as I said, look at the bigger picture. Look at where the growth is likely to come from. Again, there is a lot of detail that I can talk about this company, but I think this video is getting really long. People will start commenting that this video is really long, but I feel like if I have to speak about 2-3 companies, then I have to at least give you 7 to 8 minutes commentary about each of these companies. And if you like this commentary, request you to hit the like button. Let me know in the comments. Simple thank you. It motivates me to do a lot of work for you and bring this nice, precise content packaged in a good story format within 20 to 25 minutes of video. Now with that, if you want me to create the series, as I talked about in the earlier part of the video, if you want me to create a series of, let's say, 10 videos and I give you total 30 companies, their insights in terms of what's happening, let me know in the comments. I would be happy to do it only if I get good number of comments, let's say 1000 plus comments. Otherwise, I'll feel like there is no interest in that type of content. I won't create it. Okay. With that, I'm going to see you in my next video. Until then, keep rocking.